Hello, hello. Welcome to Innovators Live powered by Boast. Today is Friday, January 27th. As you know, capital efficiency is more important than ever, especially in the midst of uncertain fundraising market. In the next few LinkedIn Lives, we will dive into various options on how you, as founders, can tap into non-dilutive resources. Welcome. My name is Anastasia. I'm the Director of Strategic Partnerships at Boast, and I'm joined by Chikei Yeung, Director of Quick Fund at Boast. We will be talking about capital strategy on how to fuel your R&D activities so you can continue your growth. Chikei, perhaps you can give us a quick intro about you before we dive in?
Sure. Thank you, Anastasia. Good afternoon. Good morning, everyone. My name is Chikei Yeung, Quick Fund Lead and Director here at Boast, and happy to jump on today's call and talk about some, capital strategies for R&D. My background, quick background, I've been with Boast for just under a year. Been working in the financial sector, primarily helping early stage and early commercializing tech companies access growth capital and working capital. So, yeah, that's it.
Thank you. We're so lucky to have you. And for anyone else who's kind of like just tuning in, if you have any questions, feel free to just put it in the comments. We'll address them as we go. So let's start with the basics. Chike, tell us what are the top three sources of non-dilutive funding for founders when they think about R&D projects, product development, and such things?
Sure. Let's jump into that. I think the first thing to define, I think many of the listeners probably have an idea of what non-dilutive is. And those who don't, quickly, it's just capital that's added to your company that doesn't affect your shares and dilutions of your equity. So, some non-dilutive options out there, of course, is debt instruments, loans. Could be a private loan, could be a loan from a chartered bank, or something in between. Obviously, some other ideas are other non-dilutive capital is tax credits. Here at Boast, we're experts in tax credits. And the other one is grants. We're big proponents of grants, great programs out there federally and provincially across the country, and some in the U.S. as well. Grants are great, especially one of our biggest partners is IRAP. We see a lot of them in the ecosystem helping out companies access to funding. Again, non-dilutive in nature, so really, really, welcoming for a lot of founders that are looking to grow, their capital strategy.
Great. Okay. So those are kind of like big, broad subjects already. Let's dive into one of them. So let's talk about debt. Do you have any examples of the types of debt that are available for maybe for seed round founders or pre-A and Series A founders?
Sure. Yeah. So the most common debt we see on existing companies is probably something in the lines of a convertible note or a convertible debenture. Really, it is dilutive in nature, but it does behave like debt. There's interest accrued throughout the life of the term, and upon maturity, the investor may or the agreement may trigger dilution. But often, depending on the outcome or what they agreed on, it doesn't always. So that's a type of kind of hybrid debt equity instrument that we see lots. Other forms of debt that we see in the marketplace is, I used to work at in banking, growth capital, working capital. It could be a line of credit, right, for kind of day-to-day operations. That's not really used for R&D, but more to cover, monthly payroll or invoicing, some AR/AP pains. The other form, some banks will issue some growth capital, working capital over a span of 5 to 7 years, which is great. The caveat is that generally they're looking at companies with some cash flow, right? As we all know, not every tech company has cash flow in the early stages of the seed stage, especially in the seed stage, right? So, one of us, amongst other firms in the country, we offer shred financing, right? So, before waiting to get your refund from CRA, there's options on the table, a lot better than they were 10 years ago, from what I understand. That is quite friendly, quite welcoming, very patient in nature. That helps a lot of companies access, debt financing through a shred backing, right? So that's probably the most common thing we see here at Boast, and that we can help with as well.
Awesome. Thank you. And then you kind of open doors to like tax credits there. So let's talk about tax credit for a little bit. Like how can we actually use tax credit to help with R&D projects or product
Sure.
development?
Sure. So, as people are familiar with, or if you're not familiar with, the SHRED program under CRA is more or less a spend it to earn it kind of program, right? So, after a year end completes, It concludes a firm like ourselves, or many of the ones out there, will prepare a tax claim and get those credits back. Depending on CRA timelines, you can get that refund within, call it 60 days to 180 days. It depends, I guess, on the complexity of the claim, the timelines of CRA. Accessing, financing against this is a great option for companies, and you'll see this. Me say this word a lot in today's call. Part of the capital strategy is having options. So leveraging, a shred claim to advance some working capital is a great option for many founders, as we'll hear, and you'll see that, a lot of times the comments we hear from companies that, CEOs and that founders that have, raised seed, Series A to, whatever letter to exit. A key strategy is always having options on the table, right?
Yeah,
And we think we're well positioned, and many other firms as well, to help companies access R&D financing, right? So
absolutely.
getting that capital maybe 6 months earlier, 8 months earlier, is quite important, right? That dollars can be spent back into R&D, or maybe meet certain payroll obligations, or expand into certain segments and products. So again, those optionality of having working capital today versus a year out can change and alter a company's growth plan and roadmap.
Great. And for those of us, for those who just join us, as an FYI, kind of a SR&ed or R&D tax credit in the US essentially is a program from the government, from both from the CRA and IRS, that allows you to recoup a portion of your product development costs. So what does that mean, product development costs? It could be the cost of your senior backend engineer, of your CTO, and then a lot of their time and salary altogether. You can get in Canada up to 64%, or in the US, depending on the state, anywhere between 10 to 17%. So there are a lot of different options there. If you think that the minimum or like average salary for a backend developer is at 100K, think about getting up to like 64K of that back at the end of your fiscal year. That's a lot of money that you can potentially reinvest back to the company, either by hiring another developer or access that earlier to like beef up the company or the product roadmap delivery a little bit faster. The third bucket, Chike, that you talked to us about was grants. So we talk about loan, we talk about tax
Mm.
credit, and there's also grants. And then you mentioned IRAP. So IRAP is kind of specific to Canada. Are there any other grants that entrepreneurs and founders should be thinking about to basically finance their product development or R&D
Yeah.
projects?
Yeah, sure. There's several out there, and while IRAP is probably the champion in this space, other organizations like SDTC, so if you're a company that is working on a clean tech strategy, there's funding available as well. An application process is done online and through some of their members. My Tax is a great program to help companies access research with undergrad graduate students, right? So again, these are programs that help IDMTC. If you're a gaming company, or you're anything media or digital tax credits, those are provincial specific, province specific. So those are other credits that you can access. Talk to us, talk to the provider themselves, and the governments there. But yeah, there's many options out there. We're very fortunate in Canada to have these to us, given that the private capital isn't as lucrative as our neighbors to the south. So these programs really help our Canadian companies innovate, and take risks, right?
Absolutely. I love what you said earlier about the best R&D capital strategy is having options. So let's talk about options.
Mhm.
For founders, how can they leverage like some of these options to compete in their market? Is there an example of capital stack that they should be looking at?
Yeah. I mean, it's a good question. I think when we ask, different companies, there's always a different answer, but there is a theme that we see, and it kind of goes back to what we were saying earlier: is options, right? We don't, from what we understand, is that there isn't one binary or absolute, um, you know, kind of strategy in capital strategy for R&D. Some companies get funded from seed from a very reputable firm, but that's not the 99% of the companies that we see, right? It's so having options of seeing a little bit of self-investment, some friends and family, some seed investment, some debt from maybe a charter bank if they're willing. Oh, sorry, there's a message here. And also blending in some R&D tax credits, some IRAP. I think the stack is the best trend that we see. I think that's the great indicator that many companies decide to invoke on. I think a lot of experienced CFOs that maybe have done this once or twice always have the same behavior, which is, knocking on everybody's door, talking to all the lenders, all the private lenders, all the shred firms, and seeing what's on the table, right? Because especially as we head into some times of uncertainty in the future, and we're not sure what that looks like, we see, you know, um, different institutions behave differently, but at the same time, the same CFOs are still knocking on all the doors to just uncover who's available to offer what types of instruments in the market.
I see. So it sounds like for the experienced finance leaders, they would include equity and some sort of debt, and then
Yeah.
a little bit of like grants and tax credits in the mix, depending on what's available to them at any given time or any given revenue stage. Am I understanding that correctly?
Yeah, exactly. Yeah, that's a good way to sum it up. I think the key word is optionality, right? For founders that have worked hard and built a company and made some sacrifices,
Mhm.
dilution is always at the top of their mind, right? They want to have a successful, tenure with their firm, with their company, and a good CFO will help these founders access different options, right? Sometimes, dilution makes sense, right?
Mhm.
If it's opening doors, if and but sometimes, a company that is cash flow positive, that doesn't need to dilute, and they can access some cheaper capital, such as debt. That's how I define cheaper capital, right? I think at
Mhm.
the end of the day, you compare cost of borrowing, but also cost of dilution, right? That's
Yeah.
another major topic that many founders will share with us.
I'm smiling a little bit there because I think you hit nail on the head there. When it comes to cheaper capital for growth, if you don't absolutely have to raise capital, if you're cash flow positive and you have options, you're absolutely right that like debt and any other like options would be cheaper than equity. But for those of us who are not familiar, can you elaborate a little bit more about why debt and then even kind of like at the 13 or anywhere between like 11 to like 15 or 18% is still cheaper than giving up equity?
Yeah, sure. So yeah, this is a scenario, right, of many scenarios. A company that raises, call it a Series A, is giving up anywhere between 17 and maybe some in the mid 20s percentage, of their equity, right? So you think about the cost of capital, you're giving almost a quarter of the company away, right? So how do you quantify that to a cost of borrowing? Well, that's a quarter of everything you're earning is gone, right? So that
Mhm.
could have long-term impacts until the next liquidity event, right? Where you're looking at debt, for instance, depending on the amortization schedule, if it's a 1-year facility or a 6-year facility, you know, double digit, or single digit, low single digits, low to middle digits, cost of borrowing, call it 15%, as a high, 10 as a low, somewhere in there, it's quite reasonable given the type of risk, which is quite low, in our opinion. There's no personal guarantees tied to a lot of stretch facilities that
Mhm.
we do here at Boast. We don't even have that language in there. It's quite friendly, right? You compare that to giving up equity, right? Or in my opinion, if I was a founder, I think that's a great option, and we've heard that from many of our existing clients, right? The investment world today, given the macroeconomics, they want to issue more aggressive term sheets that have,
Mhm.
call it, a more beneficial upside to the investment firm versus the company itself, right?
Yeah.
So I think this year we're going to see a lot of, call it, very competitive and aggressive term sheets, right?
Mhm.
That founders will have to think twice on. Whereas before, before the downturn, they were getting great, multiples, and I think now it's a different story. I just got a minute warning here, so.
Yeah. No, thank you kind of for keeping an eye on time. So definitely like founders should be aware of like all these things and all these options when they're revisiting their capital strategy. Are there like slightly different ways that we can take a look at R&D and ROI on R&D versus just like thinking about it as a cost center?
um Yeah, it's a good question. It's how do we think about R&D? It's at the end of the day, you're taking a risk. Companies are innovating. They're trying to move the needle on a product, of some sort, or development of some sort. The CRA, the SHRED program is great to offset some of that risk. in the form of a cash refund.
Mhm.
And accessing debt is kind of a multiplier off of that, right? So you're almost being, rewarded for taking risk, but accessing a debt instrument is, leveraging that risk that you're already taking that's being paid
Mhm.
back. So quite low. Again, we love to see it. It could be, we don't want we. I've heard people say call it kind of a infinite money glitch where you get R&D funding and then you get financing and you put it back in R&D and it grows your R&D. That's accurate to a degree. That's not always the
Mhm.
case, right? That funding can be used for other parts of the business, right? Obviously, we love for companies to put it back in R&D, but reality is, companies have optionality. Again, that keyword is bringing that working capital up front and having the ability to make certain decisions, whether that's bolstering the cash, the cash balance just to have it, in case of, call it a rainy day fund, or maybe investing into sales, right, or upping their marketing budget. But yeah, it's a way to open up other avenues of capital through R&D to
Mhm.
the balance sheet, right, to the P&Ls.
Amazing. There were certainly a lot of key points to digest there for us and a lot of people who were just kind of tuning in. A quick recap of what we talk about when it comes to like R&D capital strategy. There are a number of different ways that you can actually finance it. The top three ways to do so would be through debt. That would be kind of like through loans or
Mhm.
anything kind of non-dilutive. And the second one would be through tax credit, something like SR&ED, and short financing. And last but not least is also through grants. This is like your IRAP, your hiring grants. These are the different kind of things that can actually help you cover the cost of labor to actually get your product out the door, or do your R&D projects. So just keep that in mind and really like take what Chikei just shared with us through to heart. The best thing about capital R&D capital strategy is to have options. So understand what your options are. And having said that, if you do want to double check what your options might be, I'm going to drop my Calendly there in the comment. If you ever want to chat about how you can actually figure out what are the options that are available to you, let me know, book a time with me. And to wrap up today's stream, we would like to share a few resources that you should check out and we're mentioning today's discussion. Definitely subscribe to our newsletter to get the latest news, and we'll be doing a recap of this session as well. That's under boast.ai/blog, and a register for our February webinar, and then we will have the link as well. And then if you ever want to chat with me, again, as I said, my Calendly is also shared publicly. So thank you again. We will see you all next Friday for our next episode of Innovators Live. Bye for now.
Everyone.